Welcome, everyone. Welcome to the session on U.S. property markets. Where are the opportunities? I've been asked by the folks to ask you to make sure that you turn your cell phones off because we are recording this. We don't want to hear your cell phone ringing. Thank you. My name is Steve Renna. I am the president of the National Association of Real Estate Investment Managers. Goes by the acronym NAREIM. And we are the trade association for real estate investment managers. We provide the industry with a platform for it to meet and discuss best practices, what's going on in the markets. It provides an opportunity for quality interaction at the highest level of the companies. The real estate investment managers in the United States, I know sometimes the definition in Europe and the United States aren't quite the same, but I think the way to define a real estate investment manager in the United States, they are aggregators of capital. They are allocators of that capital to a portfolio of investments. And importantly, they are also asset managers. They serve investment clients in a broad range, which include public and private pension funds, insurance companies, endowments, foundations, and individuals, both domestic and foreign. Many members of NAREIM are large institutional firms that have platforms in the United States, in Europe and Asia, in some cases throughout South America, as well as the private non-traded REITs and specialized entrepreneurial firms. I'm going to introduce from my immediate right the panelists, and then in a moment after I go through a few slides, we're going to ask them to introduce their companies in a bit more detail so you get a better understanding of their companies and their company's perspective. But to my immediate right, I have Greg Winchester, who is the founder of TriMont Real Estate Advisors. Next to him is Peter DiCorpo, who is the Chief Operating Officer for CB Richard Ellis Investors. Then we have Jeff Barclay, Managing Director of Goldman Sachs, and Graham Bond, who's also Managing Director of Cornerstone Real Estate Advisors. So with that, we're just going to take you through a quick overview of what's going on in the U.S. economy, the capital markets, a little bit about what's happening within the real estate market specifically, and then we'll turn it over to our question period with our panel. First, just to give you an overall snapshot on the U.S. economy, we are starting to enter into what is a clearly defined recovery period. We recently had GDP being forecast at around 3.2%. It had been sub 3 for quite a while, but certainly risks still remain. Job growth is improving. Last month we had a job growth report of 192,000 new jobs created, which by far has been the best report we've had in over 20 months. But the recovery is still moving along slowly. For the U.S. economy to be growing at the pace it should be growing, we should be creating about 300,000 jobs per month. Consumer spending. Now, obviously, consumers in the United States have taken quite a hit because of the deleveraging as a result of what's gone on in the housing crash, as well as credit card companies starting to reduce the amount of credit that they're being afforded. But consumer spending has been surprisingly strong, but generally consumers are still struggling. Real estate fundamentals generally have been improving. We'll certainly talk about that in more detail. And product supply is constrained. In the capital markets, that's really where the performance is the strongest right now. Transaction volume is increasing in 2011. The pipeline is strong. We recently had a survey conducted this past quarter of our members, and over half the members responding to the survey expected their transaction volume to double in 2011 over 2010. Investor demand is coming back. It's becoming stronger in certain areas, but as the slide shows, it's bifurcated. Really, investors are focusing, for the most part, on quality assets, both in debt and equity, and other second-tier markets and assets are still struggling. The volume of distressed opportunities, that's another subject we'll hit on. It's lower than a lot of people expected, and that's probably due to the fact that the banks have held on to a lot of their distressed assets as opposed to pushing them out. But 2011, because the banks have improved their balance sheets considerably, they may start moving some of those assets off their balance sheet and working them out. Core returns, which has been mostly the focus, have been compressed, but they're still attractive relative to other alternative investments, including public REIT investments, which have had quite a run-up in the last 12 months. This chart that was produced by ING Clarion, I think, is very illustrative of what's going on in our recovery. What this shows are downturns from around 1970, the early 1970s, far over to the left, 1980s, 90s, and then beginning of 2000, and the current one that we're in. And this is showing how long it's taken to make up the job losses that that downturn created. So you see, you were started at 19 months back in the 1970s, increasing to 28 months in the 80s, 32 months in the 90s, 48 months in the early 2000s. Now we are 65 plus months and counting, and we still have quite a ways to go to be able to replace all the jobs that have been lost as a result of this downturn. Kind of the other bad news out there, the other headwind, is the amount of mortgages that are maturing. What you see from this graph, and if you look at the third bar in from the left, that's this year, 2011. There's about $285 billion worth of new debt maturing in the last 3 years, resulting in about $800 trillion worth of debt. That number keeps going up until it starts coming down in 2014. Most of that you'll see represented by the light blue section of the bar is bank-related debt. So this is what we have to get through in order to get to recovery. So in the financial markets, we are seeing some gradual improvement. The banks are starting to lend. They're starting to loosen their requirements. The credit markets are open for business. Risk appetite's been improving. There's a lot of cash on balance sheets of a number of firms, both financial and non-financial, as firms have learned how to do more with less, and they certainly had to improve their balance sheet in order to be able to qualify for any credit. So people have capital on hand ready to deploy. The life insurers have pretty much stayed in the business from the beginning of the downturn, and they've been a steady provider of quality liquidity. And home prices, which really the home recovery is probably the linchpin to the recovery of the U.S. markets. They're forecasting that this year we will probably almost see the bottom, if not certainly see the bottom in 2012, and start having prices stabilize and perhaps start moving up. This is another bit of good news here. What this represents is the amount of construction supply by property type in the commercial real estate markets. It's very easy to see that the dark blue line there represents the 10-year average of new construction, and the orange line represents the 3-year forecast of new construction. So you'll see the 3-year forecast is well below the pace of the 10-year average, so that shows that we have a fairly constrained supply. So this is not obviously a real estate recession created by overbuilding. This slide right here indicates some results from the survey I just mentioned of NAREIM members. And what it's showing in the pie chart on the left is what particular asset class do NAREIM members think is going to be the most attractive asset class in 2011. And over 50% of the participants said that it's going to be multifamily. And the rest of the property sectors are pretty much evenly divided. You might ask, why multifamily? Well, these gentlemen certainly could add some color to that, but I'll give you 3 basic reasons why multifamily has been the strong performer and will continue to be. So one, obviously, because of the housing downturn, people lost their homes and had to then rent. People that normally were able to enter the housing market on the first run have been delayed in doing that because they can't get financing or the down payment requirements, so they're continuing to rent. And then probably the most important factor is liquidity, and that the federal government in the United States has been involved in providing liquidity during the downturn to multifamily through its government-sponsored enterprises program. These are what's called Fannie Mae and Freddie Mac. Some of you may be familiar with those. But they continued to lend during the liquidity crisis, and that, along with the demand fundamentals, has allowed multifamily to be the best performing sector. And the next question on the right goes to, well, where should you be investing geographically? And 75% of the respondents said that U.S. primarily and on the coast. And we'll be talking about that more in just a second here. What I wanted to do is just give you a little bit of a sense of where are, the top-tier markets, the secondary markets, and the tertiary markets in the United States. So you can see from this slide, going back to what our respondent said, look to the east and west coast in the United States, Washington, D.C., New York, Stamford, which is in Connecticut, Boston, and then on the west coast, Los Angeles, San Francisco, and other Bay Area cities, as well as Seattle. And these are basically your power cities. They have large economies, 24-hour international gateway cities. They have high-growth industries and high incomes and highly educated workforce. The second-tier cities, Austin, Texas, Portland, Denver, Raleigh, North Carolina, Houston, Texas, Salt Lake, Miami, San Diego, and Orange County. These are very attractive places to live. They have strong job growth and population growth, highly educated workforce. They're not quite at the first tier, but there clearly are the next alternative areas where investors and managers are looking to invest. And then if you're feeling a little more risk-oriented, want to take on a little more, you can look to the Sunbelt state cities. That's across the southern swath of the United States, Charlotte, North Carolina, Orlando, Florida, Denver, Phoenix, Las Vegas, West Palm, and others. These are basically where the housing bubble burst the worst, which is the bad news. But the good news is the U.S. population has been migrating into these cities, so they have very strong population growth. While they're volatile, they're relatively affordable places to live and present some opportunity for the more opportunistic investors. The markets obviously still remain uncertain. You know, we have our government deficit problems in the United States. It's probably the headline issue that Congress and President Obama are having to wrestle with today. The concern about rising taxes. Last year, Congress extended for 1 year the Bush-era tax cuts, but will they be extended beyond that is a question mark. More regulation in the healthcare area as well as financial institutions with the Dodd-Frank legislation. Outlook for FIRPTA, that's the Foreign Investment in Real Property Tax Act. It's an onerous tax regime in the United States, and I'm sorry to say we impose on foreign investors, which makes it very difficult for foreign investors to be able to get capital gain tax treatment on the capital gain of their properties. And we in the real estate industry are trying to work with Congress and the administration to relax those rules to promote more of a capital flow from outside the United States into U.S. properties. We still have high unemployment. It's very stubborn. Many countries, obviously, don't need to tell you, are under financial stress, and as we're seeing in Libya and across North Africa, a lot of geopolitical concerns. So with that, I'm going to ask our panelists to introduce themselves and their companies in greater detail. And Greg, why don't I begin with you?
Sure. My name is Greg Winchester. I'm one of the owners of TriMont Real Estate Advisors. We're based in the Sun Belt in Atlanta, Georgia. We provide asset management and servicing to about 75 different global clients. Our portfolio is around $55 billion, and it's principally in North America, but we just recently announced that we're opening an office in the Netherlands to serve Europe.
Hi, I'm Peter DiCorpo, and I'm the Global Chief Operating Officer for CBRE Investors. We are a $37 billion investment manager. We work on a global basis in the U.S., Europe, and Asia. We also do a series of indirect businesses. We have a security business and also a fund-of-fund business and a new vehicle where we're actually working on the debt side of things. We are part of the large organization, CBRE, which is the largest real estate service provider in the world. And we were very pleased in February where we announced the opportunity for CBRE and CBRE investors to acquire the majority of ING, Real Estate Investment Management. We are acquiring the European, Asian, ING Select and Securities business from ING, and what will then turn us to be about a $100 billion real estate investment manager around the globe. So we're extremely excited about that opportunity.
My name is Jeff Barclay. Thank you. I recently joined Goldman Sachs last year. Before that, for 17 years, I was one of the senior partners at ING Clarion Partners, the portion of ING Real Estate that did not go to join CBRE.
And you'll see a trend there because that's sort of the reason why we couldn't buy the American.
Well, that's very nice to hear you say that, Peter. I joined Goldman to establish a new real estate investment management business at Goldman in our investment management division. We are launching our first fund. The fund will be Core and Core Plus in the U.S. And we will, once we get that launched and take on some initial separate accounts with whom we're already having conversations, we then hope eventually to expand outside the U.S.
I'm Graham Bond with Cornerstone, as Steve mentioned. The company is headquartered in Hartford, in Connecticut, and we are a real estate investment manager with about $30 billion of assets under management. We deal in both debt and equity, public and private sectors, and our clients range from predominantly in the US to the public and private pension funds, endowments and foundations, to a variety of investors from Asia and from Europe. And the strategies that they typically follow are in the core to value-add sector with a little bit of what I would call opportunistic. And we deal with all the different property types from office, retail, industrial, multifamily, and one of Cornerstone's particular strengths is actually in the hotel sector, that is within the US. And at this point in time, we have a number of different types of funds in the market. An open-end core fund for the US, a value-add fund for the US, and we're just actually working on something we're calling the Nordic Social Infrastructure Fund, which will, not surprisingly, be in the Nordics, and a German retail fund.
Terrific. As you know, there's a 15-minute question and answer period at the end of this session, but we are not adverse, and as a matter of fact, we are encouraging you to ask questions throughout. When you do ask a question, either during the program or in the 15-minute Q&A period, please identify yourself and your company. And also, before we begin, it would be helpful if we know a little bit about who's in the room. So just by a raise of hands, can you tell me how many people here are investors? Okay, and how many people are developers? And some brokers? Okay, and investment managers? Oh, one in the front and the back, okay. All right, well, thank you. The first question, I talked a little bit in my slides about the outlook for the economy overall and real estate, but I'd like to get a sense from each of you what you think, what your expectations are for 2011 as opposed to what they were compared in 2010. You know, kind of generally talking about the overall economic outlook that your firm has, your view on credit availability, access to liquidity. Graham, since you were last, why don't you be first this time around and we'll work this way.
I knew you'd do that.
Yeah, you saw me looking at you.
Well, briefly, I guess from our point of view, 2011 in prospect and forward looks a whole lot better than it did in 2010. The economy, I think Steve has very succinctly characterized it and described it. And as I say, we are certainly looking forward to a better environment in which to invest the capital we have on behalf of our clients. And that is really predicated on the fact that I think we feel the market has bottomed, probably with 35 to 40% declines across the board. That's a generalization. So the sense is the only way from here, hopefully, is upwards. I think the question is how quickly will that happen? And our sense is that that's actually going to take, obviously, varying degrees of time depending on the particular sector that you're looking at. So, as we heard, multifamily seems to be recovering rather quickly. I think, for instance, in the office sector, that will be somewhat slower because the fundamentals of supply and demand are having a greater influence, obviously. So we've not seen a huge increase in rental levels, but they're starting to occur. Tenants are getting less concessions. Space is getting less, as it were, by virtue of an increased demand from the tenants in the market. In the hotel sector, we've seen a significant improvement in the travel and business on the leisure and travel side. And consequently, occupancies at hotels are significantly increasing. So it was interesting to see the slides up there. I was at a conference recently, and the investors in the room were asked, where do you see the greatest opportunity? And the response was multifamily. And the second one was actually for hotels. Now, that's not to say that they would actually invest in hotels, but that's where they felt the greatest opportunity might exist for appreciation in value. So I guess I would say, and not to take too much time, that our outlook is more optimistic, albeit relatively slowly over the coming 12 to 18 months.
It's hard not to be more optimistic now than last year, and Goldman Sachs' economists are very optimistic, perhaps even leading the pack in terms of both timing and degree. But with that optimism comes a real need to focus on the availability of opportunities and the level of flexibility that people have. And I think the big difference between a year ago and today is that the players in the markets in the U.S. now have more flexibility than they did a year ago. You know, everything was paralyzed, whether you were a borrower or a lender. There were standoffs everywhere. No one wanted to do anything. The whole phenomenon of kicking the can down the road was really mutual. And now, with the advent of more equity and debt capital into the markets, and with a brighter outlook, people are showing more flexibility. And I think that is going to be the most important factor in bringing transaction volume up and allowing for opportunities.
I would tend to agree with what both gentlemen have said. There is a much brighter outlook for the U.S. I think people tend to really feel that. And again, it's not too hard to be a little bit brighter than we were sort of 12 months ago, and certainly 18 months before that. There is emerging a bit of a sort of a have and have not mindset within the United States. A lot of the key gateway cities like New York, Washington, D.C., San Francisco have seen pretty substantial increases in pricing, activity, volume. There's plenty of debt available for those types of opportunities. There are those markets, however, that are a bit of the have-not markets, which don't have that level of equity or debt available to them. They still haven't seen tremendous improvement in the fundamentals. So there is a bit of a have and have-not mindset within the United States, which I think we are probably going to see for a bit of time going forward. That will certainly present some opportunities for us in some of those have-not markets. But generally, the market is very excited about 2011. I think we view it as a real opportunity to take advantage of some markets that have not been somewhat picked over, and really take advantage of the pricing that we're seeing.
Generally, I would agree with the other panelists. I think from our viewpoint, the major challenge continues to be the drag of housing on the economy. But some of the good news is that consumers are moving towards deleveraging. The savings rate is staying around 5–6%. And so both companies and real estate operators and consumers are moving towards a better financial condition overall. In terms of opportunities, the other one that I would mention is that we're starting to see the beginning of clearer opportunities in the distressed debt space. We're seeing that some of the financial institutions are finally getting enough reserves to start letting some of the properties come out, which is creating some opportunities for investors, whether they're funds or wealthy individuals or small private investors.
Very good.
May I add to that, Steve?
Yes,
I was
please,
interested during the Nouriel Rubini presentation this morning to hear a questioner from the audience talk about the European banks still being somewhat stuck. And I think that's a big difference between the European banks and the U.S. banks. The U.S. banks have started to flush through with the low interest rates provided by the Fed and so forth, and showing a lot of earnings. And I think they may be actually ahead of the European banks on that front.
Yeah, and Greg, you service a lot of lending portfolios. Are you seeing a greater willingness of lenders to be putting money out for commercial real estate on more favorable terms?
You definitely are seeing that now versus a year and a half ago. CMBS securitization is back. Last year was the beginning of it in a material sense, where there was $15 billion of new issuance last year. This year, there's estimated to be $40 to $50 billion. That's still, 20 to 25% of what CMBS was at its peak, but it has definitely come back and is slowly coming back. Loan-to-value ratios are going up slightly. There's actually been some concern by the rating agencies about some of the underwritings, which I think will continue to be they'll continue to be assertive in terms of trying to make sure good underwriting standards prevail on new issuance. So CMBS is back, and that's a good thing to resolve maturing debt. The life companies have definitely been active and have been taking advantage of the marketplace, and some of the stronger banks are back issuing debt. We are seeing other foreign lenders, whether they're from Canada or Mexico or Asia, that are coming in and starting to lend more in the United States, particularly on the trophy properties.
I think, if I can just pick up on that point, one of the things that we've seen through our finance group is that there really is the focus. There's been a huge bifurcation in the market, i.e. the prime properties, the first class trophy, as you referred to them, Greg, type properties against which you can secure incredibly cheap financing at this point in time. But if you went into a lesser quality city, in a lesser quality building, you'd still find it extremely difficult. So although there's an enormous amount of debt available in the market, it's very selective and it's very focused on the higher quality properties in the better located cities.
Yes, sir.
Hi, my name is Mike Gottlieb with Citation Capital Partners. Mike Gottlieb with Citation Capital Partners. I'm a mortgage banker in Southern California. And what I've heard the last few days, and I've heard no differently today, is this bifurcation of demand for product. And the question is, and I'm sure each of you have thought about it, is how do you differentiate yourselves to put money out? Because as I see it, it's going to be extremely difficult. And where will you take risk? Because you're going to have to take risk.
Well, I'll take a crack at that. I think the focus on the major gateway cities is a very hard strategy to execute. And so you saw some charts up here with what were called second-tier cities. The word second tier is somewhat pejorative, but those are very, very good markets to invest in. And as Graham said, many of those markets have not seen the hyper-lending that are going into the primary cities, and therefore the debt-driven pricing hasn't yet come to them. So I think it's typical and almost inevitable that when capital returns to a market, it goes to the safest place first, and then it starts percolating its way down. I think a good investment strategy is to try to stay ahead of that and perhaps either buy ahead of it and or sell into it. And so that would be my recommendation.
And maybe further, Jeff, on that goes into the question is investor expectations and demands. You know, there's been this bifurcation. Why don't each of you talk a little bit about the demands that you're experiencing and the expectations you're experiencing from your investors, and are what you are telling these investors about what their expectations should be? Are they aligned? Are they different?
I think, number one, most investors' expectations for real estate investments have come down for a variety of reasons. One is because the overall return environment is so low. And even this morning from Nouriel Roubini, it's expected to stay relatively low. Number two, many of the strategies that expected to get very high, super high returns from a real estate have simply not turned out that way. So the highly levered, highly structured investment approach has been certainly put on hold for the moment. And therefore, to put a number on it, if you look at the actuarial assumptions of U.S. Institutional investors, they've come down anywhere from 50 to 100 basis points just in the last year. So they're now hovering around sort of a 7.5% return. So to the extent that they want to invest in real estate as part of their portfolio, they're really not necessarily shooting for the moon. That's number one. And number two, the orientation, if you've seen just February 14th, CalPERS, the largest U.S. pension fund, came out with a brand new strategy. They had had enough of the opportunistic strategy, and they're now going to devote 75% of all their new money to core real estate through a set of operating partners. So I think that in and of itself indicates at least in that case, a shift back to lower expectations.
Maybe to build on Jeff's point, that return sort of expectation that investors have, if you look at it and compare it to sort of the prevailing bond yields that are existing sort of in the United States, the spread between sort of a real estate return and that bond yield is at historical highs, sort of 350 basis points to 500 basis points. So it is, a tremendous opportunity right now, and obviously the low leverage that, or the low rates on leverage that you're able to put on real estate are making those returns all the more attractive. So it's really been, I think, people going to a flight to quality, recognizing that those sort of cap rates have compressed and that those returns are coming down, but still relative to sort of the alternatives in the market, they're pretty attractive. And I think that that's obviously what we're seeing with a lot of our investors. When we looked in 2010 early, People wanted to talk nothing about risk. They wanted very secure, very safe, very long-term income, and that was really sort of what our task was for the beginning of 2010. As we talked a little bit about, those gateway cities have been more and more difficult to find true opportunity, and I think they may be in some ways, in some parts of the market, a bit overplayed. People are now starting to talk a little bit more about risk, a little bit more about taking on a little bit more risk in their properties, a little bit more leasing or shorter term income. So hopefully 2011 we'll see a little bit of a return to core plus and potentially even value add plays.
Just to add to that, there are, as probably most of you know in the States, there are a number of open-end core funds. Some of them very large, some obviously somewhat smaller, but it's interesting really over the last 12 to 18 months, most of those funds have gone from having a queue to get out to having a queue to get in, to Jeff's point about the focus on core property. And they tend to focus on the cities that we've been talking about. Having said that, I think that because of what's happened in regard to those funds and the amount of capital that's seeking to get into those funds, and a couple of them have queues of $2 billion plus, enormous pressure on the types of assets that are in the market, the high-profile assets. The yields have got significantly compressed, as my colleagues have said. And as a consequence, I think there really is a shift towards the value add and possibly even the opportunistic sector, because the investors are saying, is the core sector getting overheated? Are we actually bidding the yields down to too low a level? And therefore, they're almost being forced to look at some of the other areas, some of the other cities, some of those, what I would call rotational type cities, where the opportunity to get in and out presents the opportunity for a high yield.
We put about $2.25 billion out last year, and predominantly it was in core, but we also did some value add for one of our existing funds. And I will tell you that some of those, some of those competitive bid situations, you had as many as 20-odd bidders, just bidding the price up and up and up, cap rates going down and down and down. And a couple of my acquisition officers kind of came back to me and said, it's 2006 all over again. Now, again, that tends to be for these gateway cities, these haves versus the have-nots. We were somewhat successful in actually getting to sort of the sister cities, so not necessarily going to a San Francisco, but going to an Oakland, not necessarily going to a New York, but going to a northern New Jersey or a Stamford, Connecticut, not going to a DC, but maybe to a Baltimore or Philadelphia or a Pittsburgh. So trying to take advantage of some of those opportunities. Those cap rates were not as compressed as we saw sort of in those major gateway cities, but certainly it was a very heated year for your typical high-quality trophy core product.
So to add to that, and to what Graham said, the fact that there are these queues in the open-end funds tells me that there is still some discipline in the market. And the fact that people are complaining about the pricing as opposed to raising their hands and hitting the bid tells me that the opportunity is still in front of us, that eventually more properties are going to come to the market because of this firmness of pricing. And so it's more likely than not that 2011 and 2012 will have higher transaction volume at some reasonable pricing stability level, as opposed to the continued drops that we've seen over the past, call it 12 months.
Yeah, and all of this, by the way, is consistent with the recent survey we had done with our members who really think the opportunities in 2011 are in the value add and core plus spaces, not necessarily in the core and not quite yet into the opportunistic. Yes, you had a question.
I have two questions. Hi, I'm Montana. I'm a student from New York. My first question is, I know you discussed why multifamily was attractive, but you didn't really mention the ability to mark to market and where that kind of comes in, and mark to market annually, and how that makes the asset much more attractive than some other assets. And I don't know if any of the panelists can speak to that. And my second question is, when your investors start to look for opportunistic investments in a couple years when construction financing becomes a little more available, how do you think it's going to look different than it did in 2006, 2007, or actually a little earlier, 2005, and how people are going to be a bit more wary or not, and how you think that'll look?
So as a reformed multifamily investor, I think I'm going to try to answer your first part of your question. you know, obviously with the exception of hotels, which is sort of a mark-to-market on a daily basis, right? Multifamily tends to be that quickest sort of to the down and quickest to the up. When you look at multifamily, you know, we saw the fundamentals really sort of drop off a cliff, right, sort of at, you know, the start of this Great Recession. Most of those markets had a lot more vacancy than they had. Concessions, which is sort of the specials that they're offering to incentivize people to come into the door, were at all-time high, 2 and 3 months off of sort of a 12-month lease. So the fundamentals looked pretty dire sort of in the beginning of 2009. My firm actually saw that and kind of said that doesn't make sense given sort of what's going on in the housing market. You know, Steve mentioned a lot of sort of the things that are driving multifamily now positive. What's also driving multifamily is that the development pipeline shut off virtually entirely starting in 2009, and those products are not long-term sort of development projects. So you can actually get through sort of that development pipeline pretty quickly, and then there was nothing for sort of a couple-year period of time. With sort of the housing crisis, people then moved back into multifamily. You know, we started seeing a little bit of a movement out of, you know, mom and dad's garage or the basement, you know, when people actually started getting some semblance of jobs, you know, back. So that market recovered quite quickly. The development pipeline is still virtually nil. So that market really sort of saw the fastest improvement in the general fundamentals. And again, multifamily is a situation where you can typically find someone to live there. You know, an office building, I don't care how nice it is, and I don't care how beautiful your views are. If you don't have an office, you know, tenant to take that space, you can drop your rent to whatever it is, typically. Multifamily is a little bit different. So obviously, people first focused on getting these properties back up to a stable level of occupancy, and then slowly but surely the fundamentals have now been improving. And again, my firm, we started early in 2009. We were actually the second largest acquirer of multifamily in 2009, sort of an equivalent sort of top 3 in 2010. Those properties, again, because of the Fannie and Freddie financing, but also now banks have come back, and they're actually, banks and insurance companies are as competitive, if not more competitive, than some of the agencies, which has sort of never happened in the last sort of decade. Those properties have really sort of hit, sort of everyone is very interested in those properties. They're really become the darling of the investment business, and we've seen values really come back up. That being said, they're still typically below replacement cost, which I think has been a driver and sort of a risk mitigant to a lot of people looking at that market.
And I might add to that, one thing, a cautionary note on multifamily is that I agree with what Peter said about your better multifamily properties, your A properties, your B+, the well-located multifamily properties in good neighborhoods which can be improved or renovated. But one of the things we've seen is in the lower quality multifamily properties, a tremendous amount of stress. And a large reason for that is that a lot of the unemployment statistics and issues are showing up in terms of renters being unable to pay rent or having credit issues. And so there's been a lot of damage, so to speak, in Class C and D or the lower properties. And there probably will be a number of those that are either demolished or sold at, you know, 50 cents on the dollar or lower prices. So you kind of have a dual world still going on right now in multifamily due to the economy.
Can I try your second question? Okay. I think development in the next round is going to step up the level of sustainability, step up the level of design for function, certainly in office and most likely as well in distribution and in retail. Tenants are much more sophisticated than they've ever been. They've brought on board, in-house and on staff, design people who are trying to figure out how function works. So office buildings these days, as they come out of the ground, are meant to be very, very efficient because the number of square feet per employee has dropped dramatically, and the ability to cut costs is really a big function for corporate users. So I think it's going to be, design will be much better and much more professional.
And I would say just on that point, we actually have portfolios both in Europe and the U.S. that either contain sort of LEED, BREEAM, HQE, you know, environmental sustainability ratings. And we have seen good success in the leasing of those buildings over the past 18 to 24 months. Not so much in terms of getting better rent than our competitive set, but sort of being at the top of the list with regard to tenants having mandates. And I think that's particularly important sort of in Europe. People really are sort of defaulting to those environmentally sustainable buildings, especially on the office side. But it's also very prevalent in the U.S. I think that really is the future of sort of development and design, and I think that we all need to be very mindful of that as we sort of look at new opportunities once we do a little bit more healing here.
Yeah, with respect to what tenants are demanding, the LEED certification, other types of demands that they have with respect to property, the question that comes up a lot is, are they willing to pay for it? Or is the fact that they're demanding it sort of differentiating properties versus those that don't have those types of features? What are you seeing? Are tenants willing to pay for sustainability, or just by the demand is it making those properties more attractive?
Okay. Oh, great. I'll go quickly. At the moment, I think for the most part the answer is probably no. Do they want it? Yes. Are they willing to pay for it? I think it's unlikely, but to the point just made, I think they would, if they have a choice of two buildings and one has those features, i.e. LEED certified, etc., then they will go there. But I'm not sure that there's a real premium, and that's the challenge, I think, for the developer operator in trying to incorporate these features, which are obviously becoming more in demand, and indeed, I think, not only from a tenant's point of view, but from an investor's point of view. They both want to see it, and so we are seeing a greater number of questions being asked to us as an investment manager. What is our philosophy? What is our general policy about looking in the market and looking for those types of features in buildings that we seek to buy on behalf of those pension funds?
Well, my firm just moved into a very large new office building designed for it entirely in New York City. And it really doesn't look at it just from a point of view of sustainability as doing good. It looks at it from the point of view of cost reduction. And they go hand in hand. Operating costs can be reduced by good design and sustainable design. And I think the tenants are demanding that, and you get the sustainability piece as kind of the byproduct.
And when you consider that, going, for example, in the United States, creating a sort of LEED Gold building, the cost for doing that 5 years ago was pretty significant. Sort of 7 to 10% of the total building cost was sort of the additional cost to get it from a regular building to sort of a LEED Gold building. That cost has come down significantly, in sort of the range of maybe 2 to 3, maybe even a little bit more, but not much more. So the cost to do that is significantly dropped. The efficiency and the cost reduction to the tenant is meaningful. So I think that that's obviously where we're all going there. Can I make a quick comment on sort of tenant expectations?
Sure,
and so
absolutely.
forth? I think we're talking about sustainability, and I think that that's a great thing. Right now in sort of this environment, one of the things that the tenants are very focused on is us and our health, and whether or not we are healthy enough to provide them with the necessary TI, and the ongoing services to the building that they need and expect and desire. So tenants are being very finicky when it comes to various buildings, not only from the building perspective, but who those owners are and how those owners are going to be able to service the building, not only from the time that they sign that lease and start the TI work, but on an ongoing basis.
Okay. Continuing with, yes, sir.
Yes, Albert Parquet, I'm a French-based private investor. I would like you to compare the investment for a foreign investment point of view between simply buying REITs or direct investments in assets.
Okay, so the question is direct investment in real estate or investment through REITs, which is indirect investment. Anyone want to take that on? I mean, there's a number of differences. It's a different type of investment, I think. So, Peter, I'll take a shot at it if you want to.
I will take a shot at it. I think obviously the REIT market, one of the real benefits of the REIT market is obviously the liquidity that you face. You can get in and out of those investments relatively quickly. You also obviously have a function of diversity. So there's a certain benefit to that. I know the French SIC market tends not to be as liquid as some of the other markets out there, but certainly there is that element of liquidity. I think with direct property, one of the things I I like about that more is control and more ability to sort of really control your own destiny. So I think that for an investor who's sort of getting into the direct property market, they really can control their own destiny quite a bit, as opposed to sort of really being one of thousands and thousands of investors, and you're sort of just going where that group was going to take you.
Yeah. And with much lower volatility as well, obviously. And Jeff had mentioned CalPERS policy on investing in core. They also had a second policy. CalPERS, the California Public Employees Retirement System, the largest public pension fund in the United States, and I think perhaps the world, but also had a policy shift in which they will no longer use any of their real estate allocation for investment in publicly traded REITs. They want direct control, as Peter's talking about, and they want closer correlation of their investment to real estate, and they want lower volatility. So they're moving their investment in public REITs into their equities basket, and their entire real estate allocation will be just in direct investment in real estate.
And don't get the impression that at least we don't think investing in REITs is a good idea. The REIT market has been very liquid. It has survived the downturn. Of course, it had a 70% plummet in early '09, but it's come back. REIT managements now are very professional. The generation of REITs that grew up in the early '90s was mostly families and mostly companies that had either the choice of Chapter 11 or an S11. That was the joke. Either they were going to go bankrupt or they filed a REIT. Now they're through a whole generational shift. You see the merger of AMB and Prologis, which was announced, I guess, last month. That is going to be a very, very powerful company, which will have a tremendous impact on distribution both in the United States and outside the United States. So REIT investing is a great thing to do. It's really what's your objective. And I think our sense is that a lot of the REIT return is highly correlated with stock market return, so that if you're an investor looking for some degree of lack of correlation, and you're looking for that from your real estate portfolio, as CalPERS was, then you might not necessarily want to invest in REITs.
We are officially in the Q&A period, so I will ask the audience, does anyone have a question at this time, or we can continue firing away here? Anyone? Well, I'm going to continue with the young lady's question when she was talking about opportunistic investing and what it's going to look like. And Jeff, you answered that with respect to development. And kind of the classic view of what is opportunistic development was basically ground up development, some pre-lease, some space. But we haven't really talked about opportunistic investing with respect to distressed assets. Clearly, there's a lot of distress out there. There's a lot of money poured into funds designed to take advantage of that distress. Yet it really hasn't happened that much, at least to the extent that people expected. So I would just ask the panel why their thoughts are on that, and what do they think the distressed investment opportunities might be, either in equity or in debt. And Greg, I know you see the debt side of it very closely. You know, if any thoughts on that?
Sure. We've been tracking the distressed debt market for the last 2 years and have been involved with a number of clients that have made bids and some that have actually won. And I would say to you that, number one, is highly situational. The way that product is offered to the market, there's a wide variety of ways that it's coming to market. One is it may be through so-called loan sale advisors who may be offering anywhere from, say, 1 loan to 600 loans. And the loans can be in all shapes, sizes, and forms. But we've seen a tremendous amount of interest. There's been a lot of number of registered investors who are looking at this product. But there seems to be kind of 2 emerging categories we see that are truly buying debt. One is certain large distressed debt funds which have large teams in place, which can deploy people very quickly, who understand how to underwrite the distressed debt and understand where they can bid up. Even though you have troubled assets, they understand certain angles that can be taken and are not afraid at all to own the properties through enforcement of remedies. That's one area. The second area is we see small private investors coming in and buying loans that are in the neighborhood or in their marketplaces or maybe competing properties that feel like, okay, I own a warehouse here. There's one in this submarket that I've been following and I've been watching it very closely, and I really want this property and I'm willing to pay up a little bit and buy this. And so they're looking at buying the debt as a way to own. That's generally what we see. I think the one thing that's kind of different about this distressed market than some that we've seen in the past is a tremendous amount of the debt is in smaller size assets. These can be loans that are less than $1 million that are coming out of a lot of the community banks and regional banks, and it tends to be assets that are tough assets to realize cash from. They can be builder loans, they can be subdivision loans, they can be loans on convenience stores or schools or churches or atypical property types. So there are a lot of small balance loans that are going to take a lot of legwork to collect.
Anyone else have any comments on distress?
One thing that I think is true about the distressed debt market is that there's more activity than is reported. And I think that's because a lot of the activity is done very quietly by the kind of individual groups, whether it's small towns or even big towns in New York. There have been distressed debt deals done in New York that have never made the papers, and it's because none of the parties really want them to be publicized. What I've seen happen more often than not is that if a large financial institution, and many of them are hedge funds, get involved in bidding up either individual or packages of distressed debt loans, the operators walk away because they're typically getting overpriced. And the buyers there don't necessarily know what to do or how to resolve those loans. But the ones that are very successful are the ones that are being done by operators. And the moment the operator buys the distressed loan, the borrower finds a way magically to repay it. Because the last thing they were happy stringing along the bank, but once the operator gets in there, they realize that their game may be over, and they find either an equity partner or some other source of capital to pay them off. And those transactions typically don't get discussed very much. So I think there's more going on than is reported, but it's hard to know.
And I guess, add to that not just in relation to the distressed loans themselves, we're starting to see one or two of the banks who are now willing, I think it was the point Jeff made earlier, now willing to acknowledge or accept the loans because they're in a better financial standing themselves. They're putting one or two sort of individual assets into the market. And so with the odd office building, the odd retail center, we're starting to see those come to the market. But again, it's not been with the speed, the volume, and the frequency that everybody thought it would be, because the banks have really held off. This whole pray and delay, et cetera, has been in play.
And there is a wall of equity waiting for that distress. Yeah. So the lack of distress is distressing. But it is a situation where there has been, millions and millions and millions of dollars of equity raised just for the purpose of what we thought was going to happen. And for the better part of 2.5 years, that's not there. It will be interesting to see what happens with that equity as it sort of comes closer to its sort of investment period end dates, what will happen and how that will result in the markets changing. You are seeing some of these deals come in. It's very sort of drips and drabs in terms of deals coming there. But I think that because these people have a mandate to sort of get this money out, and the terms on those investment periods for that are getting close here, what will happen to that pricing?
Okay. I think it's important. Yes, sir. Yes.
Hello, this is Andrea Bugno from the Italian Chamber. I have a specific question on Miami. I would like to know what you think about Miami, the Miami market, what did it happen, and which is your personal forecast. I want to use the example of Miami just to speak about, in general, about the USA market. We have spoken about equity.
Yeah. Are you talking about residential?
Residential, mainly. I think
like the condo market situations and housing market situation?
As a key case.
Yeah.
Thank you.
Yeah, so I can give you a really good deal on a couple apartments.
Yeah, I think so.
We'll swap here, beautiful. Cannes and Miami.
Yeah, South Beach is very nice.
I think the Miami market is a bit of an anomaly sort of in the United States. It's one of those markets that really hasn't truly recovered. If you look back sort of in the heyday of sort of the Miami development scene, what was going on in Miami was that as an investor, and I saw this almost on a daily basis sort of in 05 and 06 and even before that, you were getting that last wonderful site in Miami that was close to the water and so forth, and this was the last thing that was going to get developed in Miami. And the logic behind that was this wave of money that was coming from Latin America. So it was an unquantifiable amount because Latin America was incredibly wealthy, but we couldn't put a number on it. But it was justifying effectively 50,000 units of new product coming into the market. Not a too dissimilar thing happened sort of in the Dubai market with the Middle Eastern money, but to a much larger extent. But that Miami market basically fed off of this promise of Latin American money coming in, buying these assets and so forth. And obviously when the music stopped, all of those people who had put deposits, and basically had put deposits on all these different assets had basically just walked away from their 1,000 or 2,000, deposits. So there is an incredible supply of product in the Miami market that's going to take years and years and years to sort out. What is complicated that is the fact that some of these large high-rise towers have been sitting vacant. The sponsors don't have the money to necessarily to keep up with the air conditioning and the basic needs of that building. So you basically get these buildings that are all glass facades baking in the sun, and there's a major mold issue in some of these issues. So the Miami market is a market that will take years to improve and to clean up.
Can I just add to that?
Sure.
I mean, I guess I would basically agree with your last comment, but I think it's like lots of markets in the States. And I would just use, for instance, you happen to pick Miami, I'll pick Las Vegas. Has very similar characteristics in terms of the oversupply, excesses in every respect. We've just bought an apartment project in Las Vegas for one of our funds. And the rationale, and the investors sort of typically raise their eyes and wonder why we did that. I think from our point of view, the reality is there are good deals in good markets, there are good deals in bad markets. And in this instance, we were able to buy a building which had been built as a condo, very high quality. We bought it at less than half of its replacement cost. It's been fully leased. It'll generate something like a 6.5% to 7% return. And we feel that over the longer term, that market is going to resurrect itself, to your point, albeit maybe slowly. But the supply and demand fundamentals are such that we believe we can keep those apartments full, given the pricing, given the quality. And so I think I would say, whether it's Miami or whether it's Las Vegas, there are opportunities. There are just fewer than in some of the better and stronger markets.
And I agree with both the comments. The two observations that we have about Miami that I would add to it is that the higher quality condos that have been properly handled during the crisis with good management or asset management, where prices have been reduced 30 to 50%, that product is moving, and there are investors out of South America and Canada that are coming in and are buying that property at 50 to 60% of original sales price. On the other side, there is a concern, particularly in some of the properties that were substantially sold out before the crash, where a tremendous amount of investors bought units in those towers. And now the investors who bought the units, who may have put 20 to 30% down, are seeing themselves upside down in those units where the value of the properties are less than the mortgages that they have on the properties, and between the cost of carrying the mortgages and paying the homeowner association dues and the taxes and the insurance, there's a concern that there may be a substantial number of investors who decide to let their units go back to the lenders. So again, to kind of be consistent with what the group's saying, look very carefully at the property you're involved in and who the actual users are of it.
Okay, thanks. We've got time for one more question, and if you don't have one, I'll just throw one thing out. Is there a question back there?
Can I add to Miami? I happen to be from Miami.
Yes, please do.
Okay, so of the 50,000 units that were available, 85% of that market has been absorbed. If you look at what's happening in downtown Miami, all the brand new buildings that popped up like an instant city, and I can name all the buildings and tell you what the occupancy is in every building, even marquee, between what the bank is willing to approve, 60% of that building is now under contract and sold. Everglades on the Bay, which I had written a contract for the entire building, that building sold to a group out of New York, and now they brought in a really good marketing company to sell those units at great prices. Brickell Icon, which was a related project, fabulous project, 1,200 units, 871 units as of last week are under contract, mainly to South Americans and Brazilians, and mainly all cash. Trump was another building I was trying to sell as a bulk deal, and that also is doing very well. Trump 1, Trump 2 sold, and Trump 3 is probably 30% sold at this point. So I think for high quality waterfront condos in Miami, the market is very strong.
Good. Well, thank you. We've got literally 1 minute left here, and one point I would just like to make is that if you're considering investing in the United States, obviously it's very important to consider your investment manager as the person that's going to provide you the platform for doing that. One of the things that Peter mentioned earlier in talking about CB Richard Ellis Investors' acquisition of ING Clarion, you're seeing of ING, excuse me, the Clarion did not get acquired. Thank you, Jeff, for clarifying that. That still exists. But basically, there's a bit of a trend of consolidation in the investment management industry. Graham, Cornerstone, a year ago acquired Protego, a UK investment manager. Peter, can you just give us a quick insight as to some of the thinking behind the acquisition? I know we got 10 seconds.
It was a story of a distressed buyer with a wonderful asset to sell. And that asset, if you look at the ING REIM business globally, it's a wonderful business. I mean, obviously, we've all had our challenges, but if you look at that business on a holistic basis, it is very similar to ours, but it is focused on a lot of the main regions. There was a lot of synergies between our two businesses, in that where they were strong, we weren't necessarily as strong. Where they had a developed platform, we had an emerging platform. So the combination of those two businesses, again, I mentioned, will probably be close to about $100 billion in assets under management, but the overlap between those two is relatively limited. We ended up not acquiring the ING Clarion business. That business is actually going into a management buyout. We wish them all the world of luck, and I think they're going to do wonderfully. They're going to be wonderful competitors. But that was really the area where we had the most overlap, and that would have been the most challenging from an integration perspective. But if you look at how we've bought that business, the securities business, which is a $20 billion business, our business, which is a $2.5 billion business, the European business, which is one of the industry leaders here in Europe, the Asia business, where we had a very small market, they fit beautifully, and they really don't have massive amounts of overlap. And certainly on the client side, there's very little overlap too. So it really, when we started looking at this about 9 months ago, I said to my wife that it felt like it was a bit of giving birth over this 9-month period of time. My wife then told me that I know nothing about giving birth to children, so I should stop right there. But over that 9-month period of time, we really recognized, quite frankly, that it was truly a match made in heaven. And I think they were, quite frankly, happy about the fact that we were a long-term strategic player in that business, and that we were going to be there for the long term. So I think, again, thrilled with it.
Well, we are out of time. Graham, did you have one last comment you wanted to make on your Protego acquisition? Well, thank you very much. And these gentlemen are available for questions after. Thank you.